This is Max from UNFTR for the MeidasTouch Network, and today we're going through some hair-raising data and some harebrained schemes. The Trump administration is off the rails right now. It's throwing the kitchen sink at this economy, or at least it's talking about it. As usual, there's a ton of bluster that makes it hard to separate fact from fiction. And in a way, I think his gift is a disciplined lack of discipline, if that makes sense. It's not exactly controlled chaos, but an unmatched ability to throw a monkey wrench into everything all the time. So what we're going to do is run through a couple of his more brilliant schemes, what to expect in the coming weeks with the government reopening, and a mind-blowing peek under the hood at the crisis that's brewing in the private credit market. So let's go. So here's the approach today. I'm going to start by setting the table with some macro information that builds on prior episodes to freshen up our outlook. Then we'll move to Trump's recent proposals and why they not only make no sense, but would do way more harm than good. So I'm talking specifically about creating a 50-year mortgage, sending tariff dividends to Americans, and some half-baked idea to send Obamacare subsidies directly to people. Under normal circumstances, these are terrible ideas. But we're not living in normal circumstances, and that's where I think we should start. I also have some funny Scott Bessent clips because, you know, he's my muse. Anyway, the last update that I did here on Meidas was about the broken plumbing of the financial system. It's not required viewing for today, but it's good context for the uphill battle that the Trump administration is facing to restore balance to the U.S. economy. And spoiler alert, there is literally nothing to suggest that they are actually A, trying to do that, or B, going to succeed if they do. So the upshot of our last story is that even though we didn't have access to government data over the past month, there was tons of information coming out of the private sector. So similar to how cracks began to appear in the financial system in 2007, we're seeing troubling signs in the private credit markets today. Areas of the economy that aren't really all that transparent until something goes very wrong. Basically, there are these enormous markets, financial clearinghouses with buyers and sellers that set rates that are frankly more important than the federal funds rate that gets all of the attention. So we know that the Fed recently lowered the rates to a range between 3.75 and 4%. So that's the target that they hope to pin overall market rates between. But what's been happening is that the rates are actually falling above that range in the market. So the cost of capital in the United States isn't coming down despite the Fed's attempt. So when rates refuse to come down like this, it means that the market thinks that lending is riskier than the government hopes it will be. So there have been some high-profile bankruptcies that mainstream media and financial pundits have kind of blown off as isolated examples. These are the now infamous cockroaches that Jamie Dimon was speaking about. You know, if you see one, it usually means that there are more. Well, more have broken since he said that. And yet the market, meaning the stock market, is just literally turning a blind eye to it like nothing's wrong, just like they did in 2007. So I want to show you the most recent one because the filing actually tells us a lot, and I think you'll be blown away.
Countless customers and employees are caught in the fallout of a sudden bankruptcy filing by a home renovation company that's actually backed by one of the world's largest investment firms.
This is a local story in Massachusetts about a home improvement company called NewPro. Now, this story actually played out all over the country because NewPro was part of a larger private equity-backed brand called Renovo. But searching Renovo won't elicit much paperwork because that parent company is called Home Renew Buyer, Inc. And that organization just filed Chapter 7. Now, the difference between 7 and Chapter 11 means that there's no chance for restructuring. This is as final as it gets. So here's where it gets dicey. The Renovo brand is essentially a private equity play. They were rolling up home improvement companies all around the country and putting them together for purchasing power and economies of scale. But the money behind them came from only one source. They were 100% backed by BlackRock, the biggest asset management company in the world, with $13 trillion in assets under management, or AUM. For comparison's sake, if you added the AUM of JP Morgan Chase, Bank of America, Citibank, Wells Fargo, and Goldman Sachs together, you'd still be shy $3 trillion of BlackRock's AUM. So here's the crazy part. When the books of the holding company were opened up in bankruptcy, we got a glimpse of the type of funding arrangements that it had. The company reported a range between 100 and 500 million in liabilities. Now, they only give a range in these initial filings, and yet they reported under, get this, $100,000 in assets. So somewhere between 100 and 500 million dollars in liabilities with only 100,000 in assets. This company was the definition of upside down. Now, it turns out that 100% of their outstanding liability is to BlackRock. So from what it looks like, the real figure is somewhere around $150 million. Gone. Just gone. Now that sucks, right? But check this out. This is a snapshot from earlier in the year of revolving lines that BlackRock was giving to the company, a series of short-term loans. Now, I've highlighted the calculated interest rates here, so you have 15.42, 13.42, and 15.42. But it's important to look at the calculation that I'll explain in a second. SOFR at a 2.5% floor plus the interest rate. So hold that thought. When you hear about the private credit market, that's what a lot of these deals look like. 13%, 15%, completely abusive. So let's talk about that term SOFR. This is one of the rates that we covered extensively in our last piece. It stands for Secured Overnight Financing Rate. And we were talking about how SOFR was, quote, blowing out above the federal funds rate ceiling, or 4% as of today. SOFR is essentially the actual borrowing rate of all the rates put together in the overnight market. So once all the rates settle out, this is the average rate that they wind up clearing at. The federal funds rate is the ceiling, that 4%. So if SOFR is over that, it's an indication that the Fed has, quote unquote, lost control of rates. But it's also an important rate to understand in private credit because so many of these loans are built on top of it. So in this example, SOFR at a 2.5% floor plus 11% means that it's SOFR plus 11%. So if somehow SOFR fell below 2.5%, 2.5 would still be the floor. Now, in November, SOFR went above 4%, and that's how the calculated loan can get to 15% or higher. So let's keep our eye on rates, but step back even further to illustrate the challenges for the administration. See, we are a nation built on debt. Government debt, home mortgages, credit cards, student loans, revolving lines, commercial mortgages, car loans. It's not an exaggeration to say that the American century was entirely fueled by credit. And the big kahuna of it all is the $38 trillion in government debt. So to feed the beast and keep the government's checking account full, we've been increasing the number of short-term treasury auctions that we have and maintaining the volume of long-term treasury auctions that we've been doing. But we have a problem. See, just like the Fed sets rates as a guide, and sometimes the market requires a higher rate because the borrower might be a little shaky, the same holds true for our treasury auctions. We need a lower yield to decrease the cost of borrowing. And yet, if you look at what's called the long end of the yield curve, we can look at the 10 and the 30, for example, the rates on these treasuries are stubbornly high. And that's contributing to our cash flow problem and why our annual debt service in interest only is going to be around 15% of GDP this year, nearly $1 trillion. So right now, everything the government is doing is to fill the treasury because our outflows are unreal. Even the Federal Reserve has depleted rainy day funds to purchase treasuries in an effort to keep auctions cranking and demand high. Remember, this is the standing repo facility that the Fed created in the wake of the financial crisis to make sure it had enough liquidity to backstop the markets in the event of a crash. The rainy day fund is dry because it's transferring money basically to the Treasury. Now, here's the connective tissue to our next section where we talk about Trump's plans. This is the TGA, or the Treasury General Account, basically the government's checking account. So you can see the wild fluctuations after COVID when we poured money into the system by issuing a tremendous amount of debt. And people and businesses were also flush with cash and pouring money into savings, which banks in turn put back into play by purchasing treasuries in addition to everything else And over the next couple of years, it worked its way through the system. And since then, it's been up and down and up and down. But over the last couple of months, we've seen a spike in the TGA for a couple of reasons, to the point where, as you see here, it's the highest balance outside of COVID that we've ever had. Nearly $1 trillion just sitting there and not in the rest of the economy. It's parked. Now, the first reason is that we're issuing a ton of paper to load up to pay our bills. The second reason is that we haven't been paying our bills because the government's been shut down. So when the government reopens and some of these shorter-term notes come due, the TGA is going to empty out again. Now, the debt won't really affect anything, but the markets are betting that that money to pay back bills and back pay will give a short-term boost to the economy. So that's one of the reasons that the stock market is responding the way that it is. Now, hold that thought, because Donald Trump has thoughts on what should happen next, and they're all bad. So right now, this is how things are going for Donald Trump.
I have seen your name. You solemnly swear that I will support and defend.
Despite the Democrats caving on the shutdown, the fact of the matter is that independents and Democrats are flipping out. And he's losing a ton of support nationally. Now, Democrats, of course, have never approved of him, but independents were, at least half of them, optimistic, at least the ones that voted for him, right? But now he's lost their support. But I do want to make something clear, something that I always point out. What you're looking at here is the level of support that Trump enjoys among Republicans. It is still 89%. This is a survey of 65,000 respondents. It's an online survey, and it's real time. It's not the phone-based garbage. Trump's approval among Republicans has dropped only about 2 percentage points since he retook office. So why do I show this all the time? As a reminder that these people are so far gone, it's not worth talking to them right now. Like during the government shutdown, the reason the Republicans could put up a brick wall and the Democrats were never going to win that debate, even though they should have kept going, is because Republicans know that there's nothing they can do to lose the base. Also, they hate poor people, so it doesn't even matter to them. So they're going to have to lose everything before they turn on this guy. So we have to stay focused on our messaging. Now, that said, Trump does not like to be booed. He enjoys being the most recognizable person on the planet, which he is, but he also loves being adored. And right now, he is losing his grip. And he's smart enough to know that it's because his economic policies are killing people. Now, I wish I could say that it was the environment and peace treaties, extrajudicial killings, warmongering, his mass deportation philosophy, racism, xenophobia, misogyny, Islamophobia, and general disgustingness. But it's not. It's all about the pocketbook, because it's always about the pocketbook. So he's floating all of these weird plans because he thinks it'll win people over. And he's not running them by anyone, as you're going to see by Scott Bessent's reaction in a moment. So the policies that he's floating just in the past few days are to offer a $2,000 tariff dividend to every American, giving the Obamacare subsidies directly to people, and now a 50-year mortgage, which is the only one of these things that actually might be a thing. So let's take them one by one. This is the fun part for me. Let's listen to our first clip of Scott Bessent responding to George Stephanopoulos' question about a tariff dividend.
Do you have a proposal, a formal proposal to give a $2,000 dividend to every American?
I haven't spoken to the president about this yet, but it could. The $2,000 dividend could come in lots of forms, in lots of ways, George. It could be just the tax decreases that we are seeing on the president's agenda. No tax on tips, no tax on overtime, no tax on Social Security, deductibility of auto loans. So, those are substantial deductions that, are being financed in the tax bill.
Okay. Indulge me for a moment because I find this guy fascinating. Scott Bessent, The man who lost 90% of the value of his hedge fund, the worst hedge fund manager ever, the guy who started out with over $5 billion in his fund and less than $500 million when it was wound down after losses and redemptions. When he's caught off guard with something like, hey, your boss said you're going to give everybody in America $2,000, if you watch him, his mouth starts quivering and he looks like he's about to burst into tears. And you know it's different because when his smugness comes prepared with gotcha talking points like he did 10 minutes earlier in this same interview, this is what he looks and sounds like.
The president continues to post about ending the filibuster. Is that the best way to end the shutdown right now? Is that what the administration's position is?
No, George, the best way to do it. And look, you were involved in a lot of these in the 90s, and you basically called the Republicans terrorists, and you said that it is not the responsible party that keeps the government closed.
So that's about a minute in. He came loaded with that little pearl, and he was so happy with himself. Now contrast this again with his response to the dividends.
I haven't spoken to the president about this yet, but it could the $2,000 dividend could come in lots of forms, in lots of ways, George.
I'm sorry, I know I'm being petty, but that's his tell. When his mouth starts quivering and he gets cry face, he's lying. There's no plan to give every American $2,000 because it would drain the Treasury account. That checking account that we just looked at, it would be gone. Not only that, but it would produce inflation immediately on top of the inflation that we already have because it's stuck above 3%, which is a point above the Fed's 2% target as it is. And here's why. When money is poured into the system through stimulus and not the normal course of moderate and steady wage gains, it creates an artificial inflationary boost. And here's what always happens. Take a look at the divergence during COVID. This is mapping savings versus expenditures. When we were all locked down and couldn't spend money, we saved the stimulus money that the government sent to us. And Americans started paying down credit cards. They got current on car payments. They bought groceries. They paid down mortgages or refinanced them. And then the trend automatically reversed and corporate America hoovered up those excess dollars right out of our accounts and it evened out again. Quick recommendation that you'll thank me for later. If you don't subscribe to Matt Stoller's Substack, it's called Big by Matt Stoller, then do so and you're welcome. So during the inflation spike, Stoller was one of the first people to do the math and identified that about 40% of inflation during the inflation spike under Biden was caused by corporations jacking up their prices. About 30% was due to increases in raw material costs that spiked from the supply chain disruption, and the rest was normal inflation. But the bottom line is that when corporations sense that you have money in your wallet, they will take it from you. It's one of the reasons why corporate earnings has been consistently record-breaking for 5 straight years. The government gave money directly to them, and then they took what the government gave to us by raising prices. This is a key concept for one of our next bright ideas from Trump, so hold that under your hat while we finish this thought. Here's another part of the Besant interview that is also hilarious.
The president is also posting about tariffs this morning. He's saying people that are against tariffs are fools. We're taking in trillions of dollars. Is that true?
We have over the course of the next few years, we could take in trillions of dollars, George.
Trump has been boasting that he's bringing in trillions of dollars from tariffs, but he's not. He brought in hundreds of billions, but as you heard from the world's worst hedge fund manager just there, it would take years to take in trillions. And because tariffs are supposedly going to go away someday under their plan, it'll never get there. And by the way, the big holy shit moment that no one in the administration is talking about is what happens if the Supreme Court rules against Trump and we have to give all that money back. Oh my God. In what seems to be a very likely scenario, that means that the Treasury has to start liquidating the Treasury account to pay the bills from the government shutdown, the interest on the debt that we keep issuing, and reimburse all the importing corporations within the next couple of months. So let's be clear. The reason he's floating the tariff dividend idea is to sound like a populist, like Eva Peron handing cash to people to buy their love, and because he knows that he can blame the Supreme Court if and when it doesn't happen. And even if we indulge this fantasy, and he literally sent everybody $2,000, we know from history that corporations would immediately hike prices and take it all from us because that's what they do. It would be massively and immediately inflationary, which brings us to his next bright idea.
The president said this morning, I'm recommending to Senate Republicans that the hundreds of billions of dollars currently being sent to money-sucking insurance companies in order to save the bad health care provided by Obamacare be sent directly to the people so they can purchase their own much better health care and have money left over.
Absolutely brilliant move by the president, and I agree with him 100%.
Of course you agree with him. This is the same meathead that called out a union leader during a Senate hearing to fight outside the chamber.
You want to do it now?
I'd love to do it right now.
Well, stand your butt up then.
You stand your butt up.
Oh, hold on.
Big
Oh,
guy.
stop it.
Is that your solution every
Hold it. No, sit down. Sit down. Okay. You know, you're a United States Senator.
You gotta love Bernie. I mean, he's doing the Lord's work everywhere, even breaking up fights in the Senate. Blessed is the peacemaker, for he shall truly be called a child of God. So no, Senator Mullen, this is a stupid idea because, first of all, it's the same thing. The Obamacare subsidies are offsetting the cost of private insurance offered on the public exchange. It's the same thing. It's the same thing. All they're doing here is trying to collapse the ACA exchanges. They have no intention of sending money to people directly. And even if they did, they know that a ton of them would not purchase health insurance without an individual mandate. And the net result of that would be an increase in premiums across the board to cover for experience ratings, which is why the ACA was created in collaboration with the insurance companies in the first place. And that's why all roads lead to Medicare for all, which was a topic for another day, but should be our topic every day. Anyway, same principle applies. If you send money directly to people, corporate America will find a way to take it from them. It's called inflation. And that leads us to stupid idea number 3 to round things out. All right, this one's pretty easy. There's a great 2014 study from a Stanford economist that explained why home prices have increased so dramatically in value over the past 70 years. And there's 3 drivers. You got a rise in real incomes, favorable tax treatment of mortgages, the famed mortgage tax deduction that gives owners an advantage over renters, which is gross, and the invention of the 30-year mortgage. So similar to Stoller's inflation analysis post-COVID, Daniel Fetter, the author of the report, estimated that changes in home financing explains about 40% of the overall increase in home ownership during the period and value as well. That's why this looks like this. There's price inflation on goods and services, and then there's asset inflation, as you see in this chart. Home prices have increased faster than wages, more than GDP growth, more than inflation. It's why houses are the store of value for most families and the greatest potential source of retirement wealth. It's why the housing crisis was such a devastating blow for millions of Americans who lost their homes. So the introduction of credit is what built this economy, and it's what led to the inflation of asset prices like cars, college, and housing. This economy, as a whole, was fundamentally altered by the housing market collapse and, as importantly, our response to it in a way that masked a lot of ugliness. Our monetary response to the GFC and then again during COVID was like rocket fuel. It relaunched this economy twice into orbit. But do you know how at some point the capsule breaks from the rocket and then continues on its trajectory while the rocket slows and eventually turns to orbital debris? That's us. We're the rocket debris, launched by monetary policy just far enough to get the 1% into orbit, and then we burn up and circle the outer layer in an endless doom loop of debt. We're in a recession right now. In fact, one of the central suppositions of UNFTR is that the country never emerged from the Great Recession, the global financial crisis, or GFC. So this isn't just a critique of Trump. It's an observation of the financial markets and the real economy. We're not going to bring in trillions through tariffs. And if it did, it means our companies pay for it. And one way or another, the taxpayer will ultimately bear the burden through inflation. There isn't going to be a tariff dividend either, because either the Supreme Court is going to reverse this stupidity so he can claim it's their fault, or if they uphold his ability to tax and strip Congress of this authority, he won't pay a dividend because the money isn't there. He's not going to send money directly so people can buy health insurance because it's the same thing by another name, except that people wouldn't always necessarily buy insurance. They would pay down debt and buy more food instead, and then the corporations would raise prices on everything to take that money. But he might introduce a 50-year mortgage. And since the average first-time homebuyer in America is now 40 years old, it means that a whole generation of first-time homebuyers can look forward to paying off that mortgage at 90. And because mortgage interest is front-loaded, it means that these same homebuyers won't even start paying down principal for 15 to 20 years into these mortgages. And because the term is longer and payments would be lower, then the sellers would just, say it with me, increase prices. No matter how you slice and dice it, every Trump policy is inflationary. The thing that will, I think, continue to amaze me, long after the economy implodes, which has already begun, is the length that our political leaders and our corporate overlords will go just to protect their tax cuts. The MeidasTouch Network, I'm Max from UNFTR. Make sure to sign up for our free weekly newsletter at UNFTR.com, and you can find me on YouTube and Blue Sky at UNFTR. Thank you again to the Meidas Mighty for having me here, and I'll catch you online.
Love this video? Support independent media and unlock exclusive content, ad-free videos, and custom emojis by becoming a paid member of our YouTube channel today. You can also gift memberships to others. Let's keep growing together.